finance. I said corporate finance has four core subjects. It's the investment decision, that is the strategy. What do we do best? How do we value the strategy? What kinds of capital requirements will that do? The second core subject is financing. Do we use debt or equity to fund our growth opportunities? The third major subject is risk management. How do we eliminate major threats to the business? Which businesses should we be in? Which risks should we take and which should we lay off to others? And it's a matter of comparative advantage. Which risks are we the best in the world at taking? All other risks you try to lay it off on others. The fourth major subject is internal corporate governance. Who reports to whom? How do you measure our performance? How do you reward people? And what do you tell your investors about all these policies so that you can demonstrate that your goals are aligned with theirs? So those four core subjects are the essence of corporate finance. And I devote 4 chapters of my book, each one to one of those subjects. And I start with academics. I take the academic who knows more about the subject than anyone in the world. Mm-hmm. I follow them through their subject. Then I introduce 4 practitioners at the end of that. Then I go to, we have US CEO Pay. We have the Stern Stewart EVA management system, which I was a founding partner of that firm. We have a high yield bond market as exemplified by Michael Milken and as followed by Marty Fridson. And we have the Chinese corporate finance. Carl Walter knows more about China than anyone alive. He's a Westerner that got closest to anybody to be on the decision-making on the inside. So he is the internal voice for what happened in China. And I'll stop with that. So.
Yeah, thank you so much. I think that really explains corporate finance in a very simple way, because what I understand from it is that I think the gap in understanding of some of the market, I would say, is where they do not take governance and risk management into the sphere of corporate finance, just limiting it to just doing a M&A debt financing deal or something like that. So now you're also mentioning the experiences of the people that you explored while doing, creating this book. And what I found interesting was the comparison of different places, right? So if I were to ask you this, so does this definition fit every single nation? And also, what are the key stakeholders that work when it comes to corporate finance overall as a society, and how's that changed over the last 40 years?
Well, let me start with the first. All the stakeholders are important. The governing concept in my book is enlightened value maximization, as practiced and formulated by Michael Jensen. It means taking care of all your major constituencies. Anybody who can affect the value of the firm needs to be taken care of, invested in. But the rule is invest $1 only if you expect $1 in return. So this is customers, employees, suppliers, it's regulators, it's tax collectors, it's the local communities. You have to invest in all these stakeholders, but with your eye on maximizing long-run value. And it's not next quarter's profits. It's the entire stream of future profit that we're talking. This is not Milton Friedman's profit. It's long-run value maximization. I think Milton Friedman actually meant long-run value maximization, but the way it's been presented by the New York Times, it's as if this is short-sighted profit maximization. This is not what modern finance is all about. It's about maximizing the long-run value of the firm. Now, there are major differences among nations in their goals. A country like Japan has devoted itself to full employment for 30 years, and they are paying the consequences. The spokesman for the Kaidan Ren recently said in a Financial Times article, Japan has been in a 30-year slumber. We have done nothing for 30 years. We are now inviting American shareholder activists like Elliott Management, KKR, Bain and Company. We want them to come over and help our companies become more efficient. Why? This will end up producing larger employment, but initially it's going to make our companies more efficient, make them more valuable, and that will lead to human flourishing and full employment opportunities for our graduates where there are none. And this is all going on in China with spades. Whatever I'm saying about Japan, you multiply by a factor of 10. That's what's going on in China now. No productivity growth. The companies are not run for shareholders. And as a result, their graduates have no opportunities. They come out of college. There's really nothing for them to do in the state-owned sector.
Wow. So basically, corporate finance is connected to the wider ecosystem of well-being of a nation and wealth creation.
Absolutely.
And providing job opportunities as well. Now you mentioned about China and Japan, and also you mentioned the term modern finance, right? Do you think modern finance is the same globally right now, or is it different for, let's say, the US and the UK, and the other parts of the world are trailing behind it? And if you were to share an advice with people who run in other countries, I would say policy makers, etc., what would your advice be about how they should catch up?
Well, I think the key to American success over the last 40 years has been empowering investors, giving investors voice and decision-making power. So, corporate managers run the show, but if the managers get off track, the investors have to have the right to intervene and make changes, call for changes and make changes. And America is unique in the amount of latitude, freedom it provides investors. I think the UK and most of the Commonwealth nations also allow investors some degree of freedom. But in continental Europe and in Japan, Germany, for example, investors are just not allowed, or they have not been allowed to go in and make changes at, say, Volkswagen, which to me is a failure of corporate governance. They have never closed a plant in 100 years, whereas GM just offered 30% raises to its workforce. Volkswagen has laid off 10% of its workforce, and the remaining people are being asked to take pay cuts. Or at one point they were being asked to take pay cuts. This is a failed corporate governance system because it's been designed for full employment. So the company becomes bloated. It pursues market, and everybody ends up paying for that. Even though it appears to be the most humane strategy, you're trying to protect labor, you end up hurting your own workforce as a result of your failure to remain competitive and maximize value.
So that brings me into the activist part that you mentioned, right? So in the US, activists are praised, and at the same time, they're also target for a lot of criticism, right? About destruction of value too, because they're more money driven. Yeah. I myself, I think, spent like about 3 years in shareholder activism, helping some investors out in the US, and I really did feel the value of it. But I did also understand why some people would critique it, right?
Sure.
And I think I did a recent article. Shareholder activism still pretty much happens in the US. A little bit it's happening in Asia now, but it's not really widespread, right? Do you think that is because of policies, or just the investor mindsets in the other regions of the world?
Well, people who don't understand corporate finance think that activists are completely short-sighted. All they're doing is gutting businesses. That's the story on private equity. They just cut businesses with no thought of reinvesting. But that is so far from the truth of private equity. Private equity, when you own a business for 7 years, you have to sell it to somebody else who's probably going to be as smart as you are. And the first question they're going to ask is, how much have you been investing in the future of this business? Because if I'm going to buy, I know you're a smart investor, and you could be trying to fool me by just cutting and not replacing. But I want to know what it is you've done to perpetuate this business. And the most reputable private equity firms all do a good job of protecting the value, investing in their businesses, and that there are less reputable private equity firms, the so-called transients. And yeah, they may end up gutting businesses, and there are failures in private equity, but they're not done by the most reputable private equity firms who have these franchises to defend.
Do you think moving forward, as we get into, let's say, the future of finance, do you see more money flowing into private equity than there already is?
Yeah. I mean, the growth rate is phenomenal. But equity is today, it represents about 10%. If you assume a capital structure of 50% equity, I think private equity is 10% of public equity in the United States. Now that number is up from 1 or 2% 40 years ago. And when I look at the allocations I go to a private equity conference every year in Austin, Texas. Their private equity allocations keep creeping up. And they've kind of slowed a little bit in the current environment. I see private capital attaining an ever larger fraction of the total investment. Actually, private credit is now the big growth area, not private equity. Yep. And private credit, as I argue, is an extension of what Drexel Burnham was doing in the early 90s. They would lever up companies, not on the banks lend against assets. Private credit lends against cash flows. If you understand the corporate finance of a business, you can lever a cash flow much more highly than an asset. And so private credit lends to a much larger fraction of value. It charges higher interest rates, but it's taking market share from banks. And so this right now, this is the fastest growing area. And they know how to manage financial distress. They understand the companies are going to get in trouble, but they are there. They are there to convert debt into equity at the snap, which is what Milken did at Drexel. They understand how to manage a highly leveraged capital structure. And that is a key source of value. And my understanding is they earn 400 basis points more than banks do on the same portfolio of loans. And they do a much larger volume of it. So this is now the new growth area in private equity. And I only see it increasing.
So could we say that private equity is more efficient in allocating debt than corporate?
Oh, absolutely. No question. But public companies they don't understand how to manage debt. This is just not a competence of the average public company executive. This is what Michael Milken showed us all how to do. And then, as I said, he's the intellectual father of modern private credit. And then moved to private credit and started lending against cash flow, not against assets. And yeah, this is much more efficient, but it also depends on your ability to turn debt into equity almost instantaneously, which public companies can't do. They should stay low leverage because a growth company should not fund itself with debt. This is for mature companies. Even private equity itself has moved to, it used to be 90% levered in the 80s. It's now levered something like 40% equity, maybe even 50, as private equity, like companies like Silver Lake, extend into the growth sector.
Amazing. So speaking from the private equity versus corporate and the agency theory and, the common challenges between investors and shareholders, something that I also experienced because, I've mostly worked with holding companies. So I was forced to think as if it's my own money. But compared to, some other institutions that I noticed where money is not thought of as it's their own money and just put in a certain place for the sake of doing a deal, right? And that's where governance comes in, I guess, right? So do you think the governance structures right now are weak in the market when it comes to managing money or overall?
At what kinds of organizations are you talking about? I mean,
so if I was to ask you, how would you rank the best to the worst? Could you do that? I mean, would you say?
Yeah, private equity is the best.
Right.
But there are limits on what private equity can do. If you have a growth company, you're pure growth and you're losing money every year, that's not going to work for private equity. And there are also limits on size. So if you're a huge growth company like the Magnificent Seven, you want to operate with pretty much all equity because that's the best structure. And you might even have dual class shares, but any kind of company begins to lose its growth, dual class shares are a disaster because they keep the investors from getting at the assets, forcing management to change. Even Apple had to start paying out it had too much cash, and Carl Icahn came in and said, "Give me back the cash." And which was the right thing to do. That increased the value. So yeah, I would, private equity has far and away the best governance system, and venture capital is actually it's the equivalent of private equity for the growth sector, but it's concentrated ownership with heavy equity ownership, and that's all equity. So those two on the growth end and the mature end are the best governance structures. And then there are public companies. U.S. public companies are better than continental European companies, and they're better than Japan because, again, the secret is having investors have control. If you saw our tech sector in the US, we had a recession 3 years ago, and the shareholder activists would show up at companies and say, "We want you to cut 10% of your workforce. We want you to stop doing bad acquisitions." And these companies, some that lost more than half their value, have now regained their value. We've had a recession in the tech sector, which people didn't even notice, but that was caused by activist investors coming in and saying, stop this failed investment.
So that brings me to the point of actually let's taking a step back and exploring the concept of governance, right? Because I think a lot of people will limit governance to just the documents that are there to manage a company, a checklist of a couple of board meetings and all that, right? How would you expand that in terms of the modern context of what we just explored in how investors can use their rights and become activists and get something done, right? So how do we define governance in a holistic way, which then, gives more details, of course, in the book, but what would be the introduction to it?
You have to distinguish between internal governance and external governance. Internal governance means, are your managers, do they have the right incentives to create long-run value? You want your operating managers to have large equity ownership. And in private equity, you also want in private equity, the largest investors actually sit on the board of directors, but you can't do that in public companies anymore. But everybody wants Warren Buffett sitting on their board. You want a guy or a woman who owns 10% of the stock and who actually sits there and monitors for strategic advice. This is what JP Morgan did at the turn of the 20th century. Took large debt and equity stakes, sat on your board, gave advice. You want your internal governance structure to look like that. And then the external governance system is the one where, outside investor, there are shareholder activists who get a voice. One of the interesting developments in corporate finance is that hostile takeovers, which was the old-fashioned governance mechanism, have given way to activist shareholders. And somebody calls it agency capitalism, which means an active investor takes a 5 to 10% stake in the firm. He doesn't take control, but then he offers some proposals to management for change. And these proposals get voted on by the largest institutional investors. So the activist investor is not imposing his or her will, but this is shareholder democracy in action. It's putting up for a vote what you think you want done, but it's the BlackRock, State Streets of the world that end up getting the final vote. And the activist has a long-term reputation to uphold. An activist wants to be seen as proposing measures which are far-sighted, which lead to long-run increases in value. If you're just an asset stripper, people are going to understand that, and then the activists and the State Streets are going to stop voting for your proposals, and you will lose your credibility as an analyst. Elliott Management has a great reputation as an activist. So they can go into Southwest Airlines and basically say, we're serving notice on this company. The CEO ought to think about stepping down. They ought to think about changing policies. And they got 3 directors elected instead of the 12 they proposed. But this was not a failure. They don't want to control the company. They just want to step in there and bring about change. And then they want to get out.
Okay, interesting. So also I noticed in the book, one of the things that I appreciate about it is it's less about numbers and more about the thought process, the decisions, the dynamics, and where attention has moved over the last 40 years and where we should be focusing now. So do you think some of the corporate finance market has just been overly obsessed by numbers alone and forgetting what is actually driving, let's say, valuations, exits, investments, etc.? And do you think there needs to be more focus among institutions generally on, because this is something that I feel when I speak to some of the peers in the market, when I do believe there's too much concentration on the numbers alone, but there's a whole story behind the numbers that sometimes gets overlooked, which ends up, in bad investment decision making. Has that been something that you've noticed while you covered the last 40 years, that this realization has somehow come up and become more of importance?
Actually, I notice what I call modern corporate finance it's the end of the relevance of earnings, the death of accounting. Ruklev has a book. It says that the statistical correlation of earnings and stock prices used to be something like 50% in 1970. Mm-hmm. Today, it's almost zero. Because 30% of publicly traded companies in the United States have negative operating cash flow. In other words, they're actually losing more money each year, and something like 3/4 of those companies are actually going up in value. The larger their losses, the larger their market caps. So now I would say no. The world's smartest investors don't care about earnings. What they care about is investment. The investment. I'm going to ask you a question here. There are 2 variables which explain stock prices, U.S. stock prices, better than anything else over the last 50 years. And their correlation has gotten progressively stronger. What do you think those 2 variables are?
That's interesting. Is it the PE ratios?
It's an outcome. I mean, the PE is what you're willing to provide. We have 30% of the companies have no earnings, so their PE is infinite.
Yeah, the PE is not going to be.
Not PE. Okay, it's the increase in R&D. R&D in America has gone from 1% to 20% of assets in the last 50 years. So it's the increase in R&D and it's the increase in SG&A, selling, general, and administrative expense. That number has gone from 25% of assets in 1970 to 55% today. And you know what's in that number? It's expenditures on marketing, promotion,
It's
brand
general
building,
operations, basically running your business.
intangibles. It's the
Yeah.
investment in intangible assets. So you hear all these macro economists say America is short-sighted. It doesn't invest in its future. Property and equipment is going down because that's not where but the investment in intangibles has been going through the roof, and the correlation is really good with stock prices. So what you're seeing is companies are spending tons of money that does not show up in earnings. It actually creates larger losses. This is the Amazon story, multiplied 1,000-fold. These are companies that are losing more money, and the market keeps assigning higher values because the investors are smart, not stupid. Stupid investors bought GE and watched it watched it make every earnings target. And then they, Jack Welch was a great manager, but he was wedded to this model of earnings management. He thought he had to set up an earnings target and then meet it every quarter. So when Jeff Immelt took over the firm in 2000, he went around and met the institutional investors, and he was appalled by how stupid they were. I mean, these people don't understand what we do. It's on them. They were I call them earnings per share groupies. And maybe these are the institutions you're talking about. These investors, all they care about is earnings per share. Did you make your last target? And the world is going the other way, folks. I mean, these guys are back in the dark ages as far as I see the world. The world's smartest investors look at intangible investment, R&D. They look for the signs the company's investing in the future. And, there were companies like Progressive Insurance that you're not allowed to talk about earnings at Progressive Insurance. They actually went to monthly broadcasts of their operating P&L back in 2004. They said, every month we're going to send you how much revenue did we take in and what are our expected losses? And then you, the investor, you create earnings per share. My argument is all investors want to know are revenues and costs. Any good investor builds his own earnings statement because all the manipulation takes place by the accountants. That's where the funny stuff happens. Yeah. So if you're a smart investor like Warren Buffett, you don't talk about earnings. And that's how companies get smart investors. They stop doing earnings guidance. They stop talking about earnings. They talk about what are the rates of return on their future investment? How much are they going to do? Where are they pulling? Which investments are failing? Are they getting out of those investments as quickly as possible and then putting that money into growth opportunities? That's what the American economy does. It shuts down its failing businesses faster than anybody else, which is where all the criticism comes because Americans shut down failing businesses and they lay people off faster than any other economy. But all that creates capital for our world-beating growth sector. That's where the capital comes from for venture capital. There's a guy named Mark Rowe at Harvard who did a study of total corporate distributions over the last 50 years. Those corporate distributions, this is debt dividends and buybacks, is almost equal to total capital raising by less than S&P 500 firms. Okay. So you can see all these cash distributions are being recycled into the American growth sector. And that's, that's why, you need to cut companies in order to they're like a plant. You got to prune them to allow it to grow. That's the insights.
Can I say this? Am I right in saying this, that a good company is a company that's good at corporate finance?
Well, if you're not good at corporate finance, you have to be, some company with insane growth opportunities. It's like Elon Musk. Elon Musk is a genius. He's a visionary. He creates this growth thing. And so people will if it's Elon Musk, people will pile in. They'll give him dual class shares. See, dual class shares is basically, they're saying, I am such a great manager. I don't want you telling me what to do. I just want you to trust me and give me your money. But for any of us mortals, corporate finance is basically like Google, for example, lost its way. They started over investing. Then they hired Ruth Porat, the CFO of Morgan Stanley, because they said, we need some financial discipline here in this company. So Google has really kind of turned itself around after over-investing and splurging. Again, growth opportunity, a great technology is going to trump everything. But for any other kind of business where the growth opportunities are not clear, you need corporate finance to basically, it's the visible hand guiding the process of creative destruction. You need a visible guy saying, okay, cut this investment over here, add to that investment over there.
I see. I see. So also, am I right in understanding from what you just shared that the focus of investors, especially the sophisticated ones, has moved into long-term cash flows rather than short and medium term, like it used to be? So they don't care about.
Well, it depends on what kind of company you are.
Okay.
If you're a growth company, then it's long-term cash flow. You just want them to invest. You want to see signs that Amazon is continuing to pour money in. You don't really care so much about earnings, but when the growth goes away, then you start to focus on, you really generating the operating cash flow. And in that case, earnings can play a role there because to the extent that it mirrors operating cash flow, it's useful. But that's for mature cash cows. You use leverage businesses use EBITDA. The number of in private equity, this is really interesting. Almost every company has its own adjusted earnings, and when you bring in an investor, you actually have to agree on that. In other words, you have to have an agreement on what is the right measure for you, and it's never earnings. It's always something else that you have to craft. And then you go to your investor, and then you get the investor's agreement on that. Is this the measure that best represents our recurring cash flow capacity? So
So that now brings me to another topic of economic value added, which is a term I believe that you brought to the world, and now you go against it, or you say maybe it's not relevant anymore. Could you please talk about that, how that started, and what's the relevance to modern finance, and what are the changes to it, if that's the right way of asking?
This is EVA, which was formulated and promoted by the company I was a founding partner of, called Stern Stewart Company. This flourished back in the 90s. It was on the cover of Fortune magazine. During the 90s, we probably had something like 200 corporate clients using EVA. And what EVA does is it assesses a cost of equity capital. See, there's no cost for equity on the corporate balance sheet. So you're basically looking at your operating cash flow and then assigning a charge for equity. So it basically encouraged you to take all investments where you were earning more than the cost of capital and getting rid of everything that was earning less than the cost of capital. And this was really popular until the dot-com bubble, in which investors appeared to value only revenue growth. So they really didn't seem to care about cash flow at all. And so we lost our cachet, our businesses just dried up, and it's quite predictable in the sense that the EVA measure really couldn't capture. If you're a company like Amazon, where your operating cash flow looks like it's getting more negative every year, there's no way the EVA measure could capture your value creation. And so the managers would not get rewarded. The companies would say, okay, we can't use EVA because our EVA is negative now, and we're going to lose all our best managers. So EVA, and now you can solve that problem by capitalizing intangible investment instead of expensing it. We did that. We capitalized R&D, we capitalized some brand building, but it's still really hard or you do a great acquisition, you can capitalize the goodwill, for example, instead of expensing it. Companies just didn't want to go through all that rigmarole. It was just too hard to explain what you were doing. So they ended up losing its appeal. So it just doesn't work for growth companies. I think some private equity firms are using variations of EVA where it still works, and there are millions of them around. But yeah, it did fail, and that's because it's the movement of the entire economy from tangible investment to intangible investment, which EVA just can't deal with. Now, all that said, I have a former partner named Greg Milano, who has a company called Fortuna Advisors, who has created a new measure of EVA called he claims to be able to explain the value of Amazon using these adjustments we're talking about. So EVA can be extended to growth, but it's really hard to do. And it's so far from GAAP earnings that, you just can't, it's hard to persuade people to adopt it.
That would be very interesting. Also, you mentioned intangible assets a couple of times and how there's more value going that way. Now, one of the challenges, I think, in the modern finance world is, like you also mentioned, valuing those assets, coming to an agreement. And I think the one step before that is realizing that you have that asset, right? because that asset sometimes has to be pointed out, right, by either investor or by the company, or in some way discovered, right? So do you think have you noticed any standard ways coming out of it? Or do you think there could be a potential standard way to do that? Forget the reporting from the accounting.
Yeah, no, we did a roundtable discussion on intangible investing with a bunch of academics and a couple corporate types. The academics were Anil Shivdasani of Calgary and Shiva Rajgopal, who's the chairman of Columbia Accounting Department.
Okay.
And they have kind of a system where what you're looking at is the operating margins. They use the case of Uber, I think. They just basically and Airbnb. So you're looking at how much of each dollar, you're actually going to harvest. So these margins are phenomenally high. So that is the key, that your value there is tremendous, because the amount of each dollar you can save, like 80%. And then you have to determine how much investment do you have to pour into that in order to realize those 80% margins. So this is kind of the way of thinking about it. And I think everybody uses some kind of formula like that, and I think Michael Dell did that at Dell Computer. And so that's what is your operating margin? And then how much capital do you need to realize those margins? You get to an EVA type calculation.
I see. Okay, very interesting. And some of the things that I wanted to ask your opinion on, which were three areas, basically: sovereign funds, family offices, and holding companies. How do you see them, as being part of the overall corporate finance, modern finance world? Do you think they operate much like private equity, or there are a few changes, or they're still figuring their way out?
I don't know a lot about this. I just read a piece this morning on sovereign wealth funds by Bill Meganson at Oklahoma. He actually advised the Italian government on privatization. He probably did 15 privatizations. So he knows a lot about sovereign wealth funds and advises them. And he says, on the whole, apart from Norway, they are not earning high rates of return. They are underperforming the market. But they have social goals as well as economic, and governments need to weigh those. Pension funds do the same thing. So I think you're willing to sacrifice some amount of return, but you can't go too far, because you're gonna, people expect you to not, if not maximize, then certainly provide competitive rates of return on these funds.
Yep.
So
I think one of the themes in your book also was about the public and the private sector working together to get more value. I think this connects to that point. So could you walk me through your discoveries and recommendations you make in that area?
Well, my epilogue is about the ESG movement and the peril, promise, and pitfalls. And I've been writing. When I was at Morgan Stanley, I started devoting an issue every year to financial sustainability. In other words, what can corporations do for society while still preserving their own market value? What kinds of investment can they undertake? And there are a couple companies that came to mind that I think have done a remarkably good job. And one of them is Walmart. Walmart, is the largest private sector employer in the United States. They have spent a lot of their workforce. They've raised wages across the board. They have free college tuition programs. They promote from within. The average store manager is a guy who rose through the ranks, who makes, or a guy or girl, $175,000 a year. And Doug McMillan is now the president of the Business Roundtable. So he has become a highly regarded figure. And then they also have they have to take care of their supplier. They're known for being tough on their suppliers. They impose a lot of pressure, but they also support their suppliers. They advise them and they try to help them, because they have an interest in the well-being of their suppliers. So they want to make them more environmentally sound and comply with local regulations. And then they have the largest plastic waste cleanup program in the world. So I am really impressed by what Walmart is doing. And that company probably doubled its value in the last 2 years. So the market is really paying attention to and regarding it. And then the other company I like to talk about is Exxon, which is probably the most demonized country in America. They were, there was a hedge fund, I think it was D.E. Shaw, that took a large position about 4 years ago. And they said, look, you guys are over investing in exploration and development. We want you to cut back and pay out more capital. Then there was a new group of activists that came along, and they said, this is the Engine One proxy fight. We want you guys to get into renewables and solar. Even though Engine One actually won that proxy contest in the sense they got two out of three directors elected, Exxon stuck to its guns, did not invest in renewables and solar, which is what BP and Royal Dutch Shell did. BP and Royal Dutch Shell both lost half their value by getting into renewables and solar. So Exxon stayed within its realm of comparative advantage, and it instead invests in lithium mining. Lithium mining is kind of an extension of oil and gas. Blue hydrogen and carbon sequestration. They were represented at the talks at Doha, the environmental talks. They played. I'm told they played a very respectable role.
Yep.
And the investors seem to be appreciating the steps that Exxon is taking to make the world a cleaner, better place. So I think that is good ESG. But when you have things like the Sainsbury Living Wage campaign, where they insist on regulating the wages of everybody with whom the company comes into contact. Well, that one, 5 out of 6 investors ended up rejecting the Sainsbury Living Wage proposal, and rightly so, because that proposal would have just destroyed the competitive future of the company. So there are limits on the ESG movement. Has a lot of good things going for it, and companies are still investing in their workforces, even though they're getting out of the climate commitments and these formal UN-backed bodies. The same initiatives are going on at these companies. They want good workforces, they want good reputations. And that's one of the messages of my book. A company's reputation for treating its clients and all its stakeholders gets built into the stock price in the form of a higher PE multiple. I call that the magic of finance capitalism. The investors, they like what you're doing, but they also want to know that they can stop if they don't like what you're doing, they need to be able to reach in and have a voice. Again, that's the theme of my book, The Magic of Finance.
Yeah. So the magic of finance and the whole modernization, based on all the discussion we've also had, if I were to ask you, and let's take private equity, because we said, they're the best at managing debt and all that. What are some of the good things you would keep about private equity, and what are some of the things you would probably let go of if we were to say, talk about a next generation or futuristic private equity firm that even, does better than what it's been doing already? What would your thoughts be on that?
Well, PE has a terrible public relations problem. If you read the New York Times,
it's almost like they don't care about the public opinion.
No, and there's a reason for this. There are tons of private equity firms, and the large established ones have they have a major investment in their reputation that they will invest in ESG and doing good. They will avoid deals that end up tarnishing their reputation. But there are all these transient companies that come in and out that really are opportunists. People have to understand that. In other words, when a fly-by-night private equity firm comes in to try to buy a company, the sellers are going to be doubtful. They're going to say, I don't want to do this. But what private equity is really good at, one of the things that private equity is good at is actually exploiting government regulations. So if you have a student loan program, private equity is really good at finding loans for your students and for colleges that aren't very good. And the same thing with nursing homes. They are good at getting around regulations. If there's government money involved, they can find a way to squeeze, but the government is a terrible negotiator. So private equity will always find ways to squeeze money from out of government programs. So the warning really has to be sent to the government. Look, you need to hire some sophisticated people to do the negotiating for you so you are not fleeced, or you need to deal with reputable private equity firms, because everybody's reputation gets trashed by these bad transactions. But when the government is a payer, there's going to be waste and inefficiency, and private equity, unfortunately, will find ways to exploit that. So
I see. So over the last 40 years, if I was to ask you, what are the 3 main turning points that have led us to the current state of corporate finance? What would be those 3 phases that you would?
Okay. Well, what triggering event was the failure of corporate America in the 1970s. The bloated conglomerates were unable to inflation that was imposed by bad public policy. So that basically created this reassertion of shareholder control. The market for corporate control basically got kicked into action. The companies started taking over these badly run companies or putting pressure on them to do the right thing. So that, and then for the past 40 years, the market for corporate control and shareholder activists have basically, it's been a process of continuous restructuring in which anytime an excess is forming in a corporation, an activist will come in and squeeze out that excess. And what that has done, with the exception of the global financial crisis, which I think has been completely misunderstood, I believe that was largely a public policy failure, which people don't talk about. But with the exception of the global financial crisis, our corporate control markets basically continuously cut out excess, avoiding the need for a large recession. So 5 years ago, when every macroeconomist was telling people we were going to have a recession, I think I was the only voice saying, no, these companies are not like the companies of the 70s. All your macro models that are forecasting a recession are based on the experience in the 70s when these bloated conglomerates could not respond to interest rate hikes. Well, today's companies are lean and mean, and they got shareholder activists breathing down their neck. So we've been having continuous recession, smoothing out the business cycle. Rick Reeder at BlackRock has this theory that says there is no more business cycle. And the way the theory works, in my explanation, is activist investors keep creating recessions in any industry where there is overspending. So we have our recessions serially, industry by industry. So we don't need a big recession. So I think that's the biggest change. And again, the biggest challenge to all this is the pressure by society for corporations to do good things. You have to show that you're making contributions. So this is where enlightened value maximization comes in. What investments can you make in your share, which you can demonstrate are actually increasing the value of the firm? And part of this, this stuff doesn't show up in cash flows. A lot of it shows up in the cost of capital. So investors, if they like what you're doing, like Warren Buffett, I argue that investors will give you a lower cost of capital. That is, they will put a higher price earnings multiple on your shares, and if only because you have less political and regulatory risk. This makes sense in economic terms, but it also makes investors by giving them a lower cost of capital. Now, if you're an ESG investor, the downside is you're not going to earn abnormal rates of return. You're actually going to earn lower rates of return, because the lower cost of capital means a lower expected return. So ESG investing per se just has lost its luster completely because the markets are giving these companies a lower cost of capital. So there's nothing left for you as an investor profit from that. And that's part of the scam. And I think that's why the right-wing reaction to ESG is actually a recognition that ESG is not going to outperform the market.
So I love the fact that you mentioned the policymaking issue in the financial crisis, and also the economists saying one thing while the corporate finance reality was another. Right? Now, this is what I call the financial literacy gap, not just at the basic level, but also at the corporate level, where the managers, policymakers, stakeholders, or people putting out opinions out there. There's a big gap of financial literacy. And this is something I've noticed while going out training CEOs and senior executives in other companies on corporate finance. And there was almost to a point where companies are now asking if I could come up with a way to measure the financial literacy in the company that, and how does that link to the company? Do you think that is an element that has been highly ignored and needs to grow? Do you have a suggestion of how that could probably grow? I think reading your book is probably one of the ways, for sure. I'll tell you, it definitely increased my financial literacy.
Okay, great.
How do companies address that?
That's music to my ears.
No, I'll be honest. It made me think of so much that was, I would say still confusion. I'm supposed to be an expert in corporate finance, but of course you're always learning, right? But your expertise in the last 40 years made me cover something that through experience, it would take me maybe 5-10 more years. Yeah, to be honest. Yeah.
But you got to get old like me.
Exactly.
No,
that's why I'd love to hear from you about that financial literacy.
I wrote this book.
Overall. Yeah.
Okay. My contention is that American literacy, financial literacy, I mean, especially about corporate finance, is abysmal. I mean, people learn capital asset pricing. They get training in, do I invest in stocks or bonds? But they don't know anything. This is even true of the CFA, the Chartered Financial Analyst Foundation. I mean, there's almost no training in corporate finance. So people don't understand how corporations add value, both economic and social value. And that's and they don't even talk about this in finance classes. And this is why I'm writing my book. What is the role of corporate finance in social well-being and human flourishing? Well, how does that happen? And as I said, I agree completely. The Jamie Dimon had issued this call for folks, we need greater financial literacy, but I'm trying to specify that we need literacy about corporate finance. What do companies do? How should they be run in way? And how does corporate profit seeking end up making us all better off? This is what Adam Smith told us 250 years ago. You get the 9 guys in a room making some nails and how they can produce more nails working together than alone. And that simple insight is that creates the social wealth that can then be redistributed. One of my favorite questions is, how can you justify Apple paying a 5% tax rate? And I can say, look, Apple has a PE ratio of 50. So every dollar extra you make them pay in taxes reduces social wealth by $50. Sure. So you can get Apple to pay one more dollar, but that's $50 that gets spread around to everybody. And macroeconomists just refuse to recognize this value. They just basically, oh no, that maybe we'll give them 2 or 3% credit for a dollar of investor gain. They just do not believe stock prices are real, that the wealth created is real. And I'm trying to argue that macroeconomists and public policymakers should pay attention to stock prices because they are private sector productivity, which creates social wealth. They just, as I said, neither of those groups believes that stock prices, they think they're a mirage. Donald Trump can destroy $2 trillion in 2 days. But as I say, I've been looking at this for 45 years. And for 45 years, the US market is still, it's like $55 trillion. It is something like 3/4 of the total global equity wealth has been created in the United States. And that money gets spread all around the world in just unfathomable ways. So that's my message. And if you can help me spread the word, I will be your friend for life. I'm warning you, that you don't want to do that, but
I will tell you. So the reason I started writing the newsletter, so I have like 41,000 and growing people now reading.
Is that right? Really?
Yeah, on LinkedIn. Yeah, on LinkedIn.
I mean, that's more than I've ever had in my 45. I mean, you have so far exceeded my audience that you're gonna have to tell me how you do it.
I'll tell you, I did it out of frustration. So I've worked with. So I'll just these are not the questions about the interviews now, but this is like I'm really what you're talking about. So I worked with 2 billionaires, and I worked before that 6 months in Deloitte. And before that, I started selling my consulting services while I was still doing my studies in London. And so from that, I got to work with Bank of China, investing into Pakistan, this and that, working with accelerators, venture capital firms, and then worked in a family office, worked with another accounting firm, then worked with a Japanese holding company and acquiring companies around the world, which was led by one entrepreneur who had done 77 acquisitions and knew exactly why. The ones that did not work, why did they not work? So we had a very interesting playbook. From that, then I came to Dubai, set up my own advisory firm, worked with a sovereign fund. And now I go around the region, training people on wealth management, investment management, corporate finance, and of course, doing my own corporate finance advisory work. But there were so many issues when I would go and speak to someone that I just couldn't say to their face. So I was like, where do I put this energy, right? Because through this whole journey, I really started feeling what could be done better in certain ways. So I just started a small newsletter, and I don't know, over 2 years, it's grown to now 41,000. And it would be great if we can have like an ongoing discussion, because my other thing is now I'm actually launching something called FinLit, which basically means financial literacy. Because I went to Jordan to train a bank. I went to Saudi to train a bank. I do trainings there. And I start noticing, and I ask people, what do you think the financial literacy is of this region? And the guesses that I get and the reality is such a big gap, right? So really establishing what financial literacy is also is something very interesting. But yeah, so that is my big goal. And that is why I was so excited to actually meet you now, especially when after I read the book. This was almost like, I was like, wow, how did this happen, right?
No kidding. That is music to my ears. That is why I wrote the book. I mean,
That's amazing. That's amazing.
I don't think,
I'm not sure if you are on LinkedIn or not.
what's that?
Are you on LinkedIn?
No, I'm not. I'm a techno moron, but
Maybe we should get you on there so I can, more of these ideas can spread around. And I don't know if you've ever traveled outside of the US with any of these ideas before.
I was in London last week.
So, but yeah, in the UK, I have an existing partnership with an angel investment network, which I think now has evolved into a research platform and investment promotion also for governments, which I think is another very overlooked area in corporate finance. So last year, I actually advised the Ministry of Investment on how to attract investments to the country, and it's in a way of storytelling. It was in a way very similar to how you did your book. It would be very interesting to have these conversations, of course. Thank you so much for your time. I do have so many more questions, but I think it would be nice if we could do maybe multiple sessions, because what I want to do is post each one, ask my audience for any questions as well. And I would be really happy if I can get you onto LinkedIn.
Okay. All right. I'll give it a try.
You should, because, that's where a lot of I'll tell you this, it's needed. What you're doing, I think it's needed a lot on LinkedIn, because LinkedIn has become one of those platforms where these corporate ideas are not spreading like fire. So you haven't come here to the GCC with any of this, right? With any of your ideas and books? The big thing over here is the sovereign funds gearing up to do a lot of investments in the future, right? So I think a lot of what you have to say is very relevant here. Yeah. Well, so yeah, anything you want to say in the end, Don, before we conclude this?
No, I just want to thank you. Financial literacy is why I wrote this book. So the fact that you grasp that and that you understand that these ideas are new economists, that's what, and public policymakers, the fact they haven't heard them before is just, as I said, you're really helping me out here. So I'd be happy to be involved in any joint project you want to propose. I would love to be able to help you, and you just let me know.
That's amazing. I have your email, and I will share what I'm up to and how's that going. But I really, let's get you on LinkedIn too.
Okay, it's a deal. All right. Great talking to you.
Lovely meeting you, Don.
Yes.
I truly enjoyed it. And I look forward to more interactions.
Okay, same here. Thank you very much.
Thank you.
Take care. Have a good day. Yeah, bye-bye.